Okay, now let us look at how to respond when interest rates are falling. So I'm going to give you 4 things that you should do. Then after I've given you these 4 things, let us discuss in the group. I would like to hear from you. What other things can we do? After that, I'm going to share with you an ebook where I've included some 4 other things. I think I mentioned about 8 things in the ebook, but for purposes of this presentation, I'm just going to look at the 4 things. And I'm going to be very practical with you. Number 1 is you want to diversify. This is something that we all know by now. Warren Buffett said, don't put all your eggs in one basket. So you don't just want to rely on government bonds, especially when the interest rates are going down. Combine these bonds with a mobile money business, or with farming, or with any other investment that pleases you. Of course, later we are going to look at the 10 investment options. I think I posted something about this some time back, so you can look at those and then see if there's anything that interests you from there. Now, here is the thing. When you are diversifying, you want to have a major thing that you are investing in, and then some other thing that you are diversifying into. You don't want to have too many smaller investments which are not giving you any meaningful cash. If you can stretch it to only 3, but don't have too many investment options. So for instance, if you have 100,000, you can put a 60,000 in bonds, and then you get a 25,000, put it in your business, and then you get a 15,000 and invest it in shares. Now you'll be doing that maybe just for 3 years. Then after 3 years, you can now change. You can now start doing maybe 60,000 in your business, then 25,000 in bonds, maybe depending on circumstances. But don't diversify too early, and don't diversify into too many things. You want to be focused on one thing until you are successful. So that is number 1. Now let's look at number 2. What is the second thing that you should be doing? The second thing is invest more. Yes, you got me right. Invest more. Okay, so here is the deal. If rates have gone down, for you to attain the same effect, you must invest more to stay on track. Now, this is well explained with some calculations. So I'll post the calculations in the group. But let's say in January, let's look at January 2025, a 15-year bond was giving 23.5%. So if you invested a 10,000, you would earn a 2,325 as your interest for that year. Now in June, the same 10,000, if you invested it at a 20%, you would make only a 2,000. So in short, for every 10,000 invested, you are losing a 325 kwacha. So if you still want to make the same money, what you need to invest right now is 11,625. In short, you need to put on top of what you usually invest a 1,625 kwacha to get the same effect. So in short, when rates are going down, it means that you also need to increase your investment principal so that you can have the same effect. Here is the secret. The more you plant, the larger the harvest. So that is the point number 2. So those who like asking me what is the minimum you can invest in government bonds, what is the minimum you can invest in treasury bills, we don't want to focus on the minimum right now, especially when rates are going. We want to go all in. You want to invest more. Okay, so now let's look at the third thing that you can do. The third thing that you can do is to monitor inflation closely. Inflation is the silent thief of your wealth. Currently in June, the inflation rate is at 14.1%. So you don't want to invest in bonds that are giving you interest that is less than the inflation rate, because you know that your money will be losing value. So if you invest in a 2-year bond and it is giving you 12%, and inflation is 14.1%, it means that your real rate of return is actually negative 2.1% and you are losing out money. So the solution is choose bonds or assets that are paying you more than the inflation rate, ideally for 16% and above. So why you are looking at inflation is you just want something to guide you when you're investing so that you can know what rate you can accept and what rate you can not accept. Number 4. Are you ready for number 4? Yeah. Number 4 is you keep some cash. So don't get all your money and lock it up into long-term bonds. So you want to have some cash, especially if you anticipate that the interest rates will continue going down. You want to have some money in hand, so that in case something happens, you know there are elections coming and the government might want to make you happy. So they might make sure that the interest rates are favorable on the bonds. So if that happens, you want to have some cash readily available to dive in so that you can quickly invest and take up the opportunity. So if you are investing, or whenever you are investing, always think about liquidity. So if you are using the strategy that I shared in the live workshop, you can go into the 15-year bond but leave some money maybe in treasury bills, because treasury bills mature every 2 weeks. So you'll be monitoring inflation, you'll also be monitoring the rates. If they are favorable, you get the money from treasury bills and you put it back in bonds. If the rates keep on dropping, you can now get that money and invest it somewhere else. So here is the conclusion. When rates are falling, it doesn't mean that you are going to lose. It just means that you need to adapt. The inflation rate has gone down to 14.1% because I think it was above 16%. That is good news. However, as a smart investor, you just don't have to be excited about the drop in inflation, but you want to stay diversified, keep some cash handy, invest wisely, and use a mix of long and short-term bonds. So in conclusion, when rates are going down, you want to diversify. Don't just invest in bonds only. Bonds are not the only investment option. But in case you love bonds like I do, you can just increase the money that you are investing. Then as you are doing that, always monitor inflation. Don't invest for anything lower than the inflation rate. Currently, it's at 14.1%. So this is something that can guide you. And always, when you are investing, don't just invest in 15-year bonds only. Think about liquidity as well. So you want to keep some cash. So if you've got questions, you ask in the group and then we'll be able to answer them.